Hello dear students, in the previous class we have seen common adjustments, general adjustments related to the final accounts. Now we will see typical and rare adjustments. You may be doing final accounts problem perfectly. One or two typical adjustments, if you don't have knowledge, if you don't know how to handle it, then the problem is gone wrong. You won't be getting tally. So that is why every adjustment you need to have some knowledge. So we'll see rare and typical adjustments in the final accounts. Only 7 adjustments I have taken here. The first one is discount and debtors. Bad debts treatment we know. If at all bad debts are given in the adjustments, what do? Debit side of P&L account and balance sheet deduct from the debtors. Same treatment, just like bad debts, this discount and debtors we are going to take. Why? I'll tell you the reason. Whenever we are giving discount to the debtors means they have to pay the amount. Suppose say debtors are 50,000 rupees. I am giving them discount of 2,000 rupees so that they may pay the amount. Means if I give the discount, they will be paying 48,000 instead of 50,000. So that 2,000 is loss. Giving discount to the debtors, that's loss. So same like bad debts treatment will be profit and loss account, debit side will write, and balance sheet deduct from the debtors, it's a loss, right? Now next one, discount and creditors. Discount and creditors. And creditors means from whom we have purchased the goods, they are creditors. Discount and creditors means creditors are giving us discount. In such cases, that's a income. So we'll write it in the P&L account credit side. Creditors are giving discount. That's an income. Suppose say I have purchased goods on credit basis 1 lakh rupees. Out of 1 lakh, 5,000 creditors are giving me discount. Then 5,000 is profit na. So that is I am writing in the P&L account credit side. And second effect will be balance sheet deduct from the creditors. Why deducting? Creditors amount is decreasing. Say 1 lakh creditors were there. 5,000 when they are giving us discount, automatically creditors amount is decreasing. So decreasing to 95,000 because of this 5,000 discount. That is why we have to deduct from the creditors. This is about the discount and creditors. If you remember discount and debtors, discount and creditors is quite opposite, easy to remember, right? Getting it? Discount and debtors, P&L account debit side and balance sheet deduct from the debtors. And discount and creditors, P&L account credit side and balance sheet deduct from the creditors. We have to deduct in both the cases balance sheet. Balance sheet deduct from the debtors, balance sheet deduct from the creditors. Here P&L account debit side, here P&L account credit side. That's all. Next, goods withdrawn for personal use. Personal use, we are withdrawing some goods. Goods means already purchased goods, that we are withdrawing, we are taking it. That effect will be one time trading account deduct from the purchases, because goods are withdrawing means purchases are decreasing. So deduct from the purchases. And also in balance sheet deduct from the capital. When we are withdrawing goods, so capital amount is decreasing na, indirectly. So that is why we have to deduct it from the capital. This is the effect of goods withdrawn for personal use. Next one, goods received but not recorded. This is most of the time credit transaction only. Goods purchased on credit and but not recorded. Not recorded. Not recorded means we'll record it. Simple. Not recorded, we'll record. How do we record it? One time is trading account add to the purchases. Already some purchases are there. To that we'll add it. This is new purchases. Means which is not recorded, now we are recording, so adding to the purchases. Another one is add to the balance sheet creditors. Purchased goods purchased on credit basis means creditors na, creditors value is increasing. Liability creditors is increasing, that is why we will add to the balance sheet creditors. This is goods received but not recorded, credit transaction, remember. Next one, reserve fund. Reserve fund means generally every year whenever we get profit, out of that profit some amount will be transferred to the reserve fund. This reserve fund is useful whenever we get huge losses, any kind of calamity, any kind of problems, unexpected contingency expenses, like anywhere we can use it. But reserve is taken or provided from the profit, last year profit. Last year we got a huge profit, say 1 crore we got it. Out of that, let me provide 20 lakh rupees for reserve. When I keep 20 lakh rupees for reserve, how do I treat that treatment? Reserve fund. So this always we are assuming that it's an expenses. Reserve fund amount is an expenses. In that way, we'll write it P&L account debit side. We don't assume it as an asset. If you assume it as an asset, the treatment would be different. So that is why we always write it in the one-time P&L account debit side and balance sheet liability. Like capital. Capital is directly, it's not liability. As per the business entity concept, all the capital we assume it as a liability. In the same way, reserve also, reserve fund also, exactly it is not liability, but we are treating just like a capital. So second time it comes in the balance sheet liability. Remember, P&L account debit side, balance sheet liability. This is reserve fund. Next one, commission to manager based on net profit. Commission to manager based on net profit. So here two kinds of treatment will be there. Before going to the treatment, generally whatever amount we get net commission to the manager, so that treatment will be P&L account debit side, balance sheet liability. Why P&L account debit side? Commission we are giving to the manager. When we are giving commission, loss. So P&L account debit side. We are giving, we are going to pay. So that's balance sheet liability. P&L account debit, balance sheet liability. Now calculation of commission, two types. One is payable on net profit. Commission simply payable on net profit. So whatever net profit you will find, to that rate, whatever rate. Suppose the net profit is say 50,000 is net profit. Net profit is 50,000. Then calculation of commission is you will say rate into net profit. Suppose say rate is 5%, 5 by 100. 5 by 100. Whatever amount you get, that you are going to pay to the manager. Debit side of P&L account and balance sheet liability. So this is simple calculation. Second one, payable on net profit after charging such commission. After charging such commission means whatever we get, this also we want to consider after charging such commission. Suppose say here we will be getting 2,500. After charging such commission means 50,000 plus 2,500. Including this 2,500, they are expecting commission. That is why we say after charging such commission. Then the calculation will be rate by 100 plus rate into net profit. It means 50,000 into net profit by rate is suppose say 5%. 5 by 100 plus 5. 5 by 100, 100 plus 5. Plus 5 means we are including the 5% also. That is the reason we will take 50,000 into 5 by 100 plus 5. This is only when charging, after charging such commission. If they use this word after charging such commission, then only we will take 5 by 100 plus 5. If they don't say anything, simply we will go for 5 by 100. Are you getting it? This is about commission to manager. Okay, next one, accidental loss. Accidental loss. If any goods are destroyed, theft, accident, okay, any of such cases, how do we treat this? Accidental loss generally will have insurance for every company, insurance. If we have insurance, three kinds of transaction you have to remember. One is fully insured. The goods, destroyed goods are fully insured. Suppose say 1 lakh loss. Accident loss is 1 lakh. 1 lakh insurance is there. 1 lakh insurance is there means first we'll write in the trading account credit side this amount. 1 lakh rupees, we'll write it in the trading account credit side. Credit side we have entered means it is showing that there is an accident. When fully insured, to cancel this, balance sheet asset side will write. Only two effects. One time is we are entering here. Second time is when we are receiving, to cancel that in balance sheet we'll write it on the asset side. Fully insured, no loss. We don't have any loss, right? Now second one, partially insured. Partially insured means suppose say we have total loss of 1 lakh. Out of 1 lakh, insurance company is paying 70,000. Claim. Out of 1 lakh, 70,000 is claim we are getting from the insurance company. Now 30,000 is loss. 30,000 is loss. 3 treatments, 3 amounts are there. So whenever it is partially insured, 3 times we have to take this treatment. One is here trading account credit side. Trading account credit side, which amount? 1 lakh will write. Total amount 1 lakh. Now insured amount is how much? 70,000. 70,000 balance sheet asset means we are getting it. We are getting this. So balance sheet asset side just like previous one. They are fully insured, so we have written 1 lakh. Now here we got insurance of 70,000. 70,000 will write it in the balance sheet. Now rest of the loss, that 30,000. 30,000 will write it in the P&L account debit side. Are you getting it? Total amount is 1 lakh we are writing here. Trading account credit side. Insured amount 70,000. Balance sheet asset side. And loss 30,000 P&L account debit side. Logic you have to understand. Whenever there is any loss, trading account credit side. If fully insured, then balance sheet asset. Partially insured amount balance sheet asset side. Which is not insured, loss will be P&L account debit side. Simple. Okay. In the same way, now next, no insurance. No insurance means full loss. Full loss. Anyway, first we'll enter into the trading account credit side just like previous one. Trading account credit side entering is must. So first time we are entering. Fully loss. Nothing to write it in the balance sheet. So entire loss we are writing in the P&L account debit side. Say 1 lakh rupee loss. No insurance. 1 lakh will write it in the trading account credit side. 1 lakh loss. No insurance. So 1 lakh will write it in the P&L account debit side. Simple treatment this is, right? So please note down or otherwise take a screenshot. Hope I am clear. If these adjustments, if you know, you can work out final accounts dead easy, nothing to worry. You know every transaction, what is P&L account, what is trading account, what is balance sheet, what are direct expenses, what are indirect expenses, and treatment of capital and adjustments you have idea, then why to worry? Let's start the problems in the coming class onwards. So please focus, and whenever you attend the class, immediately you take out the textbook and work out and see. Then you'll have the confidence. You'll have a good practice. Or same problem, whatever I am going to work out, the same problem without looking at the solution, try to work out. And I would advise you to watch these videos in the screens like laptop computer or desktop computer, if possible TV. So easy to grasp the subject. Board is visible and you'll get the subject easily without much difficult. So anyway, my dear students, please take care of your studies, take care of your career, and go to the description box or playlist and you can check out whatever topics, whatever subjects you want. So already prepared lot of subjects, and daily at least one video I am uploading it for the benefit of you all. Take care. Good luck.